Now let's run through these Chapter 5 review questions. I might be able to add some comments that might make these easier to understand. So, first question. COGS, cost of goods sold, is what type of an account? Well, that is an expense. So don't forget, this is the first expense we've encountered that does not have the word expense attached to it. So what happens is once inventory is sold, the cost is transferred from the inventory account to this cost of goods sold. So just remember, cost of goods sold is literally the cost of the item that we just sold. Number 2, inventory is what type of an account? It's an asset account, and specifically it's a current asset, but we didn't get that picky. It's an asset because it has a future value. So until inventory is sold, it is an asset and it counts on our balance sheet as an asset. It does not lower our profit by counting as an expense until we sell it. Sales is what type of account? Well, that's the same as calling it sales revenue. Sales discount is what type of an account? So if we sell if we sell merchandise to a customer and then later they pay early and we give them a discount, this discount is actually offsetting or lowering our revenue. So sales discount is a contra revenue. It lowers our revenue. Sales returns and allowance. These occur when a customer returns product to us or we give them an allowance off. We reduce the amount that they owe. So this also lowers revenue. So it is a contra revenue account. The individual or business from whom a company purchases goods. A merchandising company mainly purchases inventory from these individuals/businesses. Well, they buy these goods from a vendor. Some of you might be wanting to say a creditor. A creditor means that someone who is loaning you money or letting you buy on credit. If we bought if we bought inventory from our vendor with cash, then that vendor is not a creditor, it's just a regular vendor. The cost of inventory that the business sold to customers. So once we sell the inventory to our customers, the cost is going to be going into the cost of goods sold account. Prior to selling it, the cost is inside the inventory account. Sales revenue. What do we call sales revenue minus COGS, cost of goods sold? Well, that's gross profit. And that would be shown on our income statement, as long as it's a multi-step income statement. All the goods the company owns and expects to sell to customers in the normal course of operations. Well, that's our inventory. You purchased inventory on account. You pay early, so the seller reduces the seller reduces the amount owed. So the key is we purchased inventory, we pay early, we get the discount. That is called a purchase discount. Now we don't, in the perpetual system, in the perpetual inventory system, we do not use any account called a purchase discount. This discount would just lower the cost of inventory. You purchased inventory, but the inventory is not as ordered. The seller reduces your bill as an incentive for us to keep the goods. So it's like we bought a washing machine. It was dented in the back. So we call them and tell them, we call the supplier and tell them to come and get this because we want to return it. So instead of returning it, they give us like maybe $200 or $300 off as an incentive to keep it. So because we're doing the purchasing and the seller gave us an allowance, that's a purchase allowance. Okay, you purchase inventory, but the inventory is not as ordered. You give the inventory back to the seller. So we're returning it. Since we're the one that did the purchase, that's called a purchase return, not a sales return. Sales return is if we sold it. You sold inventory, but the inventory was not as ordered. You reduce the amount that you will charge the customer as an incentive for the customer to keep the goods. All right, so this is a sales allowance. It's a sales allowance because we're the one that did the sale. The amount that a merchandiser earns from selling its inventory, well, that's our revenue. And because it's inventory that we're selling, it's called sales or sales revenue. You sold inventory on account. The customer pays early, so you reduce the amount owed by the customer. So we're giving the customer a discount. And since we're the one who sold it, it's called a sales discount. You sold inventory, but the inventory was not as ordered. The buyer gives the inventory back to us. So we sold them something and it was either the wrong color, the wrong item, or it was damaged, and the seller returns it to us. Since we're the one who made the sale, that's a sales return. What's the formula for gross profit? So in the multi-step income statement, we have net sales revenue, and then we subtract cost of goods sold, and that gives us gross profit. So it's this formula. What's the formula for net purchases? So for purchases, we take purchases, we subtract any purchase discount. So if the seller gives us a discount, that lowers the cost of our purchase. And if we return any purchases or get an allowance, that also lowers our purchases. What's the formula for net sales? Well, our sales, the net sales is our gross sales, so sales revenue, minus any discounts we've given to our customers for paying early, and minus any returns or allowances. What's the increase of cost of goods sold? Well, remember, cost of goods sold is an expense, so the increase side is the debit. What's the increase side of inventory? Well, inventory is an asset, so the increase side is the debit. What's the increase side of sales? So we need to know that sales is a revenue account, so the increase side is the credit. What's the increase side of sales discount? So sales discount will lower our revenue. So it's the opposite of revenue. It's a contra revenue. So that means its plus sign is on the opposite side. So a contra revenue or sales discount would have its increase side on the debit. Sales returns and allowance, that too offsets our revenue, our sales. So its increase side would be the opposite of revenue because it's a contra revenue. So its increase side is a debit. What's the normal balance of COGS? Remember, normal balance is just another way to say what's the increase side. So that's a debit. So we're testing you to see if you know what normal balance means. A lot of students, before we did this, did not know what normal balance meant. What's the normal balance of inventory? Well, inventory normally has a positive balance. Inventory is an asset, so it's a debit. What's the normal balance of sales discount? Sales discount is the opposite of revenue, so it would have its normal balance on the left side. What's the normal balance of sales? Sales is the same as sales revenue. Normal balance is always the plus side, so that is the credit. What's the normal balance of sales, returns, and allowance? Sales, returns, and allowance is the contra revenue. It lowers revenue, so its normal balance would be the debit side because it's opposite the revenue. And that's it.